Hi, this is Mark from Redline Trading. This is our evening newsletter, starting with this disclaimer that all signals and trading opportunities that we provide are for demonstration and educational purposes only. Participating in trading in the markets does involve substantial risk, and a trader can lose a substantial amount of money. Always carefully consider your financial position prior to trading, and never risk more than you can afford to lose. Now, I'm going to review very briefly why 95 to 98% of swing traders and day traders go broke. It's been happening for over 100 years, and that number hasn't diminished by a single percentage point because day traders and swing traders have essentially not changed their trade methodology over the course of the last 100 years. All markets, futures, forex, stocks, and cryptos are in the hands of big institutional money. We as small retail traders have no say in the future direction of price. Big institutions such as HSBC, Deutsche Bank, Bank of America, a mutual fund, a hedge fund, 401k, big Wall Street money like Goldman Sachs, JP Morgan, they control the future direction of price. And we as small retail traders have only one responsibility, and that is to ride their coattails, determine the direction of institutional money, grab hold, and ride that trend with them. If we don't, we're going to get stopped out and go broke. Now, what do the majority of day traders and swing traders use? Exactly the indicators and price patterns that are going to get us stopped out. Now, pure price action in no way tracks the direction of big institutional money. Price patterns, rising triangles, falling triangles, J-hook patterns, top calling and bottom calling work sometimes, fail commonly because they really have nothing in common with the short-term movement of big institutional money. And big institutions could not care less about Fibonacci values of support and resistance. I don't think Fibonacci ever worked. But even if it did, in today's market that's controlled by big institutional money, it's useless. Elliott wave and his 5-wave pattern, Gann theory, and his very a complex mathematical formula to describe areas of support and resistance all fail in today's market because big institutional money just walks right through them like they don't exist. The same thing with price patterns and pure price action. Divergent signals, again, are going to so commonly fail. They'll work once in a while, but they're going to fail so often that they're going to take your trading account right down to zero. We cannot top call and we cannot bottom call. A top is created by big institutional money, and a bottom is created by big institutional money. There's no mathematical way or indicator analysis to call a top or a bottom. When we think we read exhaustion, big money can come right back in and drive price higher. Where we see exhaustion to the downside, big money can come right back in and drive it lower. They're creating bear traps at the top and bull traps at the bottom. The only thing that we can do as small retail traders is ride the coattails of big institutional money. And they can take a financial instrument long and technically create an oversold condition or an overbought condition for hours, days, weeks, even months. We're going to ride their coattails in the direction that they decide to push a financial instrument, and that's the way we're going to create really enormous success. Have a wonderful weekend, and I will speak to you on Monday.